So as a developer, you may be a little bit reluctant to use your services in a market like today where you've got slower than expected absorption or weakening rent growth. You don't want some of these findings to potentially, kill your deal or even have disinterest from the equity. So I guess what do you say to that? And, is there a way to answer that objection?
Yeah, I think it's balanced. And that's really where the different services, the consulting and the research, go hand in hand with one another at John Burns Research and Consulting. You could look at our national picture and say, hey, rents have been very sluggish. There's an overhang of supply. There's a lot of multifamily supply. There's a lot of BTR supply. It's taking longer to lease up these properties. And to that end, you could say, well, wait a minute, as a developer, I don't want to be building in this market, or I don't want to hear that because I want to be putting more units into the market. At the same time, I could make a case for different markets being either strong development markets or weak development markets now. Dallas being a good example. The Metroplex is huge, right? Am I going to tell you that there's no good development opportunities in the Metroplex right now? No. I think there are some good development opportunities. It's finding the right one, and it's matching the demand dynamics with the supply dynamics. Even at the metro level, I'd say markets like Austin and Dallas, if you've got, say, a 2 to 3 year development horizon, you've got a 1 to 1.5 year lease up horizon, you're really looking at disposition in 5 years. Dallas and Austin could look completely different from a fundamental perspective than the way they do now. They're still among the two best for job growth, two best markets for job growth in the country. They're still among the two best markets for domestic migration in the country. And so if you're breaking ground today, delivering 3 years from now, disposing in 5 to 6 years, the picture is going to look completely different. And as you mentioned, starts are coming down significantly. If you're swimming upstream or if you're going against the trend, it could be a good time to start building in some of those markets, even though they've been some of the hardest hit of late. Where we really add value, I think, is by looking at, okay, what is the balance of supply and demand? We could talk about Denver. It's another high supply market, but job growth is weaker. So that's, more of a fundamental concern that I have long term. Can we turn this job growth engine around, which has been one of the weakest in the country? So it's really a kind of a multi-layered, multifaceted discussion in terms of market by market, submarket by submarket, location by location. And that's where we couple our research and our consulting together to really determine, what is going on. Our job is not to make or break the deal for a developer or an equity partner or debt partner. Our job is to tell them exactly what we're seeing in that market.